It is my pleasure to introduce our guest today, Steven Kopits. He is the Managing Director at Douglas-Westwood. He joined Douglas-Westwood in 2008 and manages their New York-based office. He has more than 20 years of experience in strategic management consulting and investment banking. And most importantly, he's an alumnus of CEPA, having completed his master's in international affairs here, specializing in international economics. So please welcome me and join Steven.
Thank you, everybody. I can now tell you that Midtown Manhattan is only an hour from here. You know, I had to come a long way, and but be that this way, and be that as it may, thank you for waiting for me patiently here, and it's a pleasure to be here. Today, I'm going to talk a little bit about oil and the economy, and some of the methodologies that we use. This is going to be a semi-academic talk, which means that people in the industry wouldn't give me the time of day for this, but since you're here at an academic institution, I'll lean on you a little bit for methodology, and then also some of our findings. I work for Douglas-Westwood. We're a UK-based company. We do market research and commercial due diligence in oil field services. That means we count widgets for large companies. Our clients are companies like GE Oil and Gas, FMC, Cameron, Baker Hughes, Schlumberger, and virtually all the private equity funds who invest in oil field services. We have offices around the world in London, Singapore, Houston, New York, which I run, Canterbury, or really Faversham, scenic downtown Faversham, and in Aberdeen, Scotland. All right. So today I'm going to talk a little bit first about methodologies that we use and how our methodologies differ from other people who have also spoken at this podium, guys like Antoine Haff or Mark Finley. And so while I think their work is very important, we follow it and we count on it, we also have our own interpretation of events, which in some ways differ materially from the ones that many of you have seen them present here. So traditionally, when you do forecasting, and many of you who are students will end up doing forecasting at investment banks or consultancies, you tend to do demand-constrained forecasting. That it's demand-driven forecasting where you start from the top and go to the bottom, and the top is going to be typically GDP growth, which you might get from the IMF or domestically from the Fed or the CBO. And then you multiply that by some coefficient to get demand growth for whatever you like, whether that's automobiles or housing, or in our case, oil. So oil demand is then a function of GDP growth with some variance, and then that in turn leads to supply growth, right? So supply follows demand. That's traditional forecasting, and if you're a forecaster or an analyst, you could spend your whole career and never use any other methodology than this. So if you say a BP forecast, this is what they mean. Now, what we've been using for oil and gas is supply-constrained forecasting, supply-driven forecasting. If you have a shortage commodity, then essentially you know that you'll be able to sell everything that you can make, right? So you know the volumes that will be taken in the marketplace. Really, you're just debating prices. So in our case, we take the oil supply as endogenous, right? We then say oil demand will essentially be 100% of oil supply, and then the linkage to GDP is then a function of that oil supply growth, okay? So let's take a look at the two different approaches. By the way, in oil and gas, the way you separate the men from the boys is with acronyms. I will tend to use them sometimes reflexively. If you don't understand what I'm saying, raise your hand and stop me and I will explain. Because a lot of these are terms that we use every day, so I may not appreciate that you don't know them. That doesn't mean you need to suffer through without asking what they are. So as I mentioned, this is traditional demand-driven forecasting. Everybody uses this. All the investment banks, all the oil majors, the US and foreign governments all use this. So in this case, if you take a look, and we'll discuss BP a little bit here, but you start with GDP growth, then you get oil demand growth, and from them, oil supply growth. Now, the way their model works is that the residual, if you have something left over that you need to cut or augment, that is done in traditional oil markets forecasting with the so-called call on OPEC. It's as though King Abdullah has a nice red phone sitting by his table, his nightstand, and whenever someone needs more oil, they have the call on OPEC. I can leave aside as to what kind of implications this have. If you said, for car makers, there's a call on Kia. After everybody else manufactures as much as they want, then we call up Kia, and they can manufacture the residual. But that's the way oil markets forecasting works. Okay? So OPEC is the one that goes up and down and balances out supply and demand in traditional demand-constrained forecasting. Here's from BP's Energy Outlook 2013. Unfortunately, I couldn't attend Mark Finley's presentation here a couple of weeks ago. I have looked at it. It's not much different from last year's. But this is the way if you were looking for whether someone is forecasting by demand or by supply, you could read clues in the text that they write. So here it says global liquids consumption growth slows to 0.8% per annum. So demand slows. Okay? So the presumption is that demand is doing something. And then further, you can go on farther down. It says OECD demand has peaked. Again, so it is demand who's doing the driving here. Okay? And further then, demand growth slows and non-OPEC supplies rise, and OPEC members will cut production over the current decade to give us spare capacity. Okay? So here's the call on OPEC. This is as it's written in BP's program. I've chosen BP because they have actually a very nice outlook, not because there's something unique about it. It's a standard presentation. Okay? So if we take a look, the way BP solves the oil supply growing faster than their anticipated demand is essentially by OPEC taking production offline, by increasing spare capacity. And if you look there, there's a kind of an implication. What Mark has done here, it's actually interesting to see. Whenever you use pictures and charts and graphs, don't kid yourself. You're always being an editor, right? You're always shaping how people perceive things. When you do pictures, presentations like this, after a while, you really know how to spin things, unfortunately, but it goes with it. But you can see that Mark has thrown in here both the peaks. The first larger peak is after the first oil shock, right? And then there was a lot of new production came online, demand collapsed, and there was a huge overhang of capacity. And then there's some anticipation that kind of period comes again where there's huge amount of increase in capacity. A lot of it has to be taken offline. And that's the way we solve a situation with little demand and relatively good supply. Okay? Now, there are some assumptions built into this approach and analysis. Those are that GDP growth is endogenously weak. So if GDP is not growing fast, it has nothing to do with oil. You can be a Keynesian, you can be a market monetarist and say it's not enough spending or not enough easy money, but GDP in this view is taken as exogenous, and it's weak, and that has nothing to do with oil. Secondly, there's a presumption that social taste or demographics has changed, and that has led to a lower trajectory for oil demand growth. Okay? So something has happened. Why don't we have that demand growth that we had 15 years ago? Well, something has changed out there in there. OPEC is central, right? OPEC is central. It has enormous leverage in the way that BP has described their equation. If OPEC doesn't exercise market discipline and reduce production, then oil prices will crash. Right? That's the presumption of that analytical framework. And a little bit with that oil prices are somehow balanced on a knife's edge. Right? If King Abdullah fails to pick up his phone, it's all quite fragile. So that's demand constraint. So let's go now to supply constraint. A supply constraint is a binding constraint view of economic growth. Just as, say, water is a binding constraint on economic activity, on agricultural activity in the desert, right? We take the view here that oil is a binding constraint. If there's not enough, it's a binding constraint on economic growth, okay? So you can have lots of constraints, but not all of them are binding. So for example, if labor markets have slack, as they do now in the US, we would not think that's binding. If interest rates are very low, then we would say the capital is probably not a binding constraint, okay? So there are many constraints that may be binding from time to time. Oil and energy may be binding constraints, but not necessarily at any given moment in time. We're arguing that in general, in this recent period, oil has been a binding constraint on economic activity, okay? So we start from the oil supply. If the oil demand is greater than the oil supply growth, then observed demand growth will actually be less than inherent demand growth. So if you had given the economy more oil, it would have taken it, okay? To convert that into GDP, we have some efficiency factor of how efficiently we can increase our use of oil, right? And that's a number, and that tells us the linkage between oil and economic growth. So in this case, we start with oil, we end with GDP, and the residual in this model is not the call on OPEC, it's GDP growth, okay? So if you have a flower and you don't have a lot of water, you give it a little water, it grows, but if you can give it more water, it'll grow more. However, once it's watered, if you give it more water, it doesn't necessarily grow more. So there's a range in which this model works. Okay, so for us, what do we need to demonstrate that we might have the conditions for a supply-constrained situation? So we'd like to see that demand is likely higher than what we've seen in observed supply-demand equilibria. We'd like to show that the oil supply is constrained, that oil is a key enabling commodity, right, that there's some linkage to GDP, that it seems to be materially affecting the economy, that efficiency gains won't be enough to offset a lack of oil, and that GDP growth is off-trend somehow. Also, we'd like to show that peak demand theories or assertions are not well-founded, and that oil prices are sustaining even in the face of supply growth in excess of forecast demand. Okay, so now we've set up supply constrained versus demand constrained. We are now going to look at some tests and take a look and see how the data fit our models, and do the data support them or refute them. All right, so let's look at supply growth. So oil demand historically increases by about 3/4 of the rate of GDP growth globally, okay? If we looked at this, and this would imply by itself about 23% oil consumption growth from 2004 to 2013. In fact, what we saw was 7.5% supply growth. If we use this methodology, even allowing for efficiency gains, normal and accelerated, we're still short more than 10 million barrels, 12 million barrels, so something like the equivalent of a Saudi Arabia and an Iraq combined. And that's why we argue that oil prices are expensive, okay? But it's not, this is actually a little bit worse than this chart shows here, because what is that 7.5% oil supply growth? So let's break down that growth. So total production, liquids production, this is crude and NGLs, is up just about 6 million barrels a day since 2005, of which a little bit less than 2 are OPEC natural gas liquids. Natural gas liquids are typically a byproduct of gas production, not oil production. So while they are treated as part of the crude oil, liquids oil supply, the oil supply broadly defined, they are in fact not related primarily to crude, but rather to gas production. OPEC liquids production, including NGLs, are largely unchanged since 2005. In almost 9 years now, there's really not much change out of OPEC. What we do say big change is the U.S. unconventionals liquids, that's shale oil and natural gas liquids associated with gas production, are up 5 million barrels per day, literally all of the net crude oil production growth in the world since 2005. Okay? To this, we can add Canadian oil sands, which are up over 1 million barrels since that time. But if we look at the legacy oil system, which existed in 2005, so not oil sands and not shale oils, but everything else, onshore, offshore, Russia, Mexico, Venezuela, Argentina, Saudi Arabia, Australia, Indonesia, Thailand, Malaysia, all the rest of those are down since 2005, okay? So the conventional oil supply, the legacy oil supply as it existed in 2005, peaked in 2005, and that is still true today. This is a very important point. If you attend presentations by Tom Eisenberg, the chief economist of ExxonMobil, or Chris Rule from BP, you know, one of the questions they typically ask is, well, do you believe in peak oil? And I found myself one of the lone guys who's put up my hand, yes, I do. You know, if you ever feel like peer pressure on the professional front, you can put up your hand when Tom Eisenberg from Exxon asks that question, and you know you're going against the grain. But the truth of the matter is that while it is true that the oil supply has not peaked as such, it is higher than it was. All of that growth has come from unconventionals, okay? We're entirely leveraged to unconventionals for the oil supply growth today. And that's one thing that Chris and Tom typically don't convey in their presentations. All right, if we look at OPEC, there's not too much here. I think it is important to note that there are significant and relatively high historical outages in Nigeria, Libya, and Iran. For different reasons, Nigeria's political instability, Iran is the embargo, and Libya is going up and down like a yo-yo now, depending upon their, sort of in the wake of the whole revolution there. They have a good bit of supply that came on just this past month. We'll have more data on that with the EIA report. It's probably out right now. Okay, so there's not a huge change here. There is some latent supply lying around of 1 million to 1.5 million barrels that theoretically could find its way back to markets in relatively short order. Libya is the primary source of that. Now, how much did all this oil cost us? So since 2005, we have spent about $4 trillion on upstream spend. That's exploration and production. That includes things like drilling services, and production platforms. It doesn't include midstream pipelines. It doesn't include refineries or retail. This is just finding and getting the oil. So $4 trillion, for those of you. The GDP of Germany is $3.5 trillion. So since 2005, we have spent more than a year's GDP of Germany just looking for oil and gas. So a tremendous amount of money. Of this $4 trillion, about $350 billion has been spent on U.S. and Canadian unconventionals, and another $150 billion. This will be online, by the way. So there's a simpler way to get this than photographing. In fact, if you like, you can just sketch it down quickly. But you can, no, that didn't fly. Okay, well, I'll try a different joke later. So 350 on unconventionals, another 150 billion on LNG and GTL. So you have about $3.5 trillion, the GDP of Germany, that was spent on maintaining the legacy oil and gas system in the last 7 or 8 years. Of this, about $2.5 trillion was spent on crude oil production alone, which is 93% of petroleum liquids today. And that $2.5 trillion bought us a decline in production of about 1 million barrels per day. So we spent more than the GDP of Italy to reduce our oil production by 1 million barrels per day compared to 2005. This is not something that you read very often in the press, right? You would think if we smoked the GDP of Italy, someone would have noticed, but in fact, it's not often commented. Just for purposes of comparison, in 98 to 05, so a 7-year stretch, we spent $1.5 trillion and added 8.6 million barrels per day of crude production. So we have historically added a lot more production for a lot less money. Okay, 2005 is a fulcrum year, and you'll see that in the data. So yeah, that's where we are. We spent not too much money for significant growth in unconventionals, and we've spent an unbelievable amount of money to try to hold down the front on the legacy system of 2005. And we're really struggling, and that's also not something you hear very often. Let's talk about demand growth. So we hear the assertion from BP and others like it that demand growth is very small, 0.8% per year. Well, does that correspond to historical precedents for this type of development? In the 1960s, between 1960 and 1972, we saw the motorization of the West, which included Western Europe, the residual motorization of the United States, and that of Japan. That was about 1.2 billion people. And in 12 years, we added 30 million barrels of consumption, from 60 to 72. Okay, 30 million barrels in 12 years, quite a lot of supply, from 20 to 50 in 12 years. Now we are seeing the motorization of the East, primarily of China, but also of other emerging economies. That's 1.3 billion people, depending upon how you want to count them. We have increased crude production by 4 million barrels per day over 8 years. Okay, so we haven't added very much compared to what we would have expected to see based on historical precedent. In fact, based on historical precedent, we would expect demand to be increasing by about 2.7% per year. So if you're going, China is a big country, and if you're going to make room for China, that's about the room that you would anticipate to make. So our anticipations, our ex-ante anticipations of demand growth for this period, say from 2005 to 2025, would be much higher, 2.7%, rather than what we've seen. And here's China. So if you take an analysis of China as Korea or Japan, well, you can take Korea and Japan. Japan is in red and Korea is in blue. The difference between Korea and Japan, that flat part, that's the second oil shock. So Korea's demand during the second oil shock from 1979 to about 1976 was essentially flat, okay? And then OPEC threw in the towel, and all of a sudden, Korea's demand again took off at the same trajectory as Japan's had 20 years earlier. So what's the read out of that? The read is if there's cheap oil around, it will be taken. And what's suppressing China's demand is not a lack of demand from China, it's a lack of affordable oil, okay? How much demand is there in China? China has added historically, in the 5 years to 2007, it added a U.S. worth of coal consumption in 5 years. In the 5 years to 2012, it added another U.S. worth of coal consumption. And it will probably add another one to 2020. Okay? That's how big China is. It's a really, really big country. And it can add a U.S. worth of consumption from nothing in 5 years. Okay? It has the potential right now to add 2 U.S.'s worth of consumption to steady state, which should be around 2030, 2035, depending upon how things go. So it can add a whopping amount of consumption in very short order, okay, both based on its historical and on our anticipated for that economy. China's about half of oil consumption growth, most of it from, well, virtually all of it from the non-OECD countries. So if you put that all together, between now and 2030, it wouldn't be particularly hard to add 50 or 60 million barrels of consumption if the oil were cheap and readily available. Okay? That would be the pattern of the 1960s, for example. That's not 0.8% per year. Now, if we take a look at the supply out in 2030, it's a range. Exxon, BP, and the EIA put the anticipated supply at about a little over 100 million barrels to 107. BP has upped this number a little bit, but not much. It's still in this range. On the lower end, we have Total and the IEA. I guess that's the French influence there. They're 95, 96. And then the peak oil guys, some of them are 75 without consideration of shales. These are all really essentially peak oil forecasts. None of them would cover another 50, 60 million barrels. Right, we're at 90 million barrels today, so 107. You have maybe another 15 million barrels that they think we can put on right now. Right, we say China alone could take that and then take it again, and then that would be half of growth. So in essence, these are all peak oil forecasts. None of these really assume full accommodation of the oil supply to likely demand. Okay, and they haven't changed much. It's actually quite a bit of consensus around these numbers, or I don't know if it's consensus or rather complacency, but no one feels these were hotly debated 4 or 5 years ago. Right now, pretty much everybody is happy to let them sit here, so we can call it consensus for the moment. Okay. Now, if you say, well, big China, how do we make room for a big China? Right? If there's not enough oil to go around, how do we accommodate China? Well, that's pretty simple. China bids away everybody else's oil consumption. And we can model that out. That's actually not that hard to model if you sit down and do it. And you can calculate that at 100 million barrels by 2030, just to pick a number, that could be a little higher, a little lower, but let's pick 100. Where you end up is that for a country like the US or Europe, we would expect a decline of 1.5% per year in consumption and 2.3% on a per capita basis, although our per capitas are falling so fast, probably those will be aligned. And guess what? Europe is right on track for that. They're right down. They're down 16% since 2005. They're right at 1.5%. The U.S. is at 14% down since 2005. And that's an interesting thing which we'll talk about. But in essence, that model has worked in the past, and so it gives us a feel for what could happen. All right. So this is another view of this, and we can see that since December 2007, the start of the Great Recession, OECD, that's advanced country consumers, not producers, have provided 50% of non-OECD emerging market consumption, okay, by seeding their own consumption. And that number is about a quarter over the last year. So where are the Chinese going to drill for oil? They are drilling for oil first and foremost on Main Street USA, right? They're just bidding away the consumption of incumbent users because that's the only place to go. Right? So you bid it up, and then the guys who use a lot release it, and that's the process we've seen. There's nothing abnormal or strange about that. The only thing abnormal or strange is that China is reaching this phase now, right, which has to do with its history. Had it been developed like Korea, we would have had these pressures in 1995, 1996, rather than almost 20 years later. I would point out to you that the countries who have experienced fiscal and financial crisis are without exception on the bottom half of that graph. So Iceland, Ireland, US, Britain, Germany, Greece, Portugal, Italy, every one of them is on the lower half, and not one of them on the top half experienced a crisis. So this Great Recession was something that was truly an advanced country phenomenon, not an emerging country phenomenon, which is quite counterintuitive by historical patterns. All right, oil prices. So there are a couple of different things. So the question is, how does supply constraint then affect oil prices or our view of oil prices? Okay, there are essentially 3 different views of oil prices today. One of these is the futures curve. That takes you back to about $90 in 2020 on a Brent basis. Another is what I would call the operator's forecast, which right now they're not quite sure how the heck to forecast prices. So they said, well, let's use $100, and $100 is a good number. And you can see this also in investment banking forecasts. You can see it if you talk to the operators themselves. Well, we'll use 100. But they don't know why, other than it seems like a number that might work. Our forecast is higher. Our forecast says, well, what we would anticipate is as we move forward, countries become more efficient at using oil. So as GDP grows, as efficiency grows, with dollar inflation, we would expect to see oil prices rise over time. Okay? So that puts us near the top of the forecasting deck. It puts us below Barclays, but in that range. It puts us well above Goldman and well above Citi. Okay? So why no price collapse in 2013? If you've seen presentations in this room, you'll see that supply was intended to outgrow demand. In fact, I've seen charts where they show that, but no price collapse, right? If you believed observed supply and demand, you would say, well, all that excess supply should have collapsed prices, but it didn't, right? Prices have been rock steady. They're $109 and really only $2 or $3 what they were more than 2 years ago. So we've had good supply growth and virtually no movement downwards in oil prices. On the other hand, if you believe that inherent demand is greater than supply growth, then as soon as oil becomes available on the market, it's sucked up very quickly. Okay? It's like if you gave a plant that was starved for water, you poured a little water on it, very quickly it would absorb that, grow, right? And then if you have more water, it would like to take that. Okay? So the issue is not that the plant doesn't want the water and that's why it's not growing. It's that you're not giving it enough water, and if you would, it would grow faster. All right. There are two caveats on supply-constrained forecasting that are important to understand. First, our supply-constrained model depends intrinsically on demand from China. So the basic model is there's not enough oil to go around, China needs a lot of oil, and therefore China will bid away the oil consumption of the incumbent users, the OECD economies, right? It's pretty simple. If you have someone who comes to the table who wasn't there before, and supply doesn't grow, and they say, well, I'd like to participate, then obviously the price is going to go up, and the guys who used to get that are going to cede some of that to the newcomer. There's nothing particularly simple supply and demand. But what's important is that China, since the beginning of last year, has shown continuously decelerating demand growth for oil consumption. And you can see it there, the last peak on the right. Going down, I'm not sure why, I'm not sure how to interpret it. But China right now is not moving oil markets, or it wasn't a few weeks ago. Okay, China's out of the markets for the moment. I don't know why. Well, I have some sense why, but yes. Yes. So it's still increasing. It is. But if you go to December, if you take Platts, then 2 out of the last 3 or 4 months were actually negative for China, and December is negative by the EIA. I'm telling you what they tell me. I don't count barrels in China. I do read the press though. Oh, I understand. And the truth is that there are different interpretations for China, right? One is that it's just an anomaly, it'll pick up again. Another is that something worse will happen. Another is that some statistical thing that's just, there's a lot of sectoral noise in China. For example, gasoline and jet fuel are up. Diesel and naphtha are significantly down. So you're getting sectoral reliance. In any event, the point here is, if China is not competing for those extra barrels very hard, right, then they're not setting the price. And that means that the person who is competing for those barrels very hard is going to set the price. And let's see who that is. Oh, yes, if you look at the gray line, you can see that that's the U.S. You remember the BP comment that OECD demand has peaked? Well, the U.S. added 1 million barrels of consumption in about 6 weeks. If the price is cheap, the U.S. has demonstrated that it can take supply very fast. Okay, so in this model, essentially, this model says that if China's not in the market, then you will see the U.S. and Europeans who are starved, right? They'll take that share that China's not competing for, and that's kind of what these statistics say. On the other hand, the question is how much latent demand is there in the U.S.? Let me go down another slide here. Here's our forecast. This is a forecast I made in 2009. It's in one of my articles. An analysis I did earlier than that. But you can see here's in blue U.S. oil demand, and you can see the yellow line is the long-term trend, and the dotted line would be our peak oil forecast based upon this chart here. That chart, okay? So that red dotted line corresponds to this chart here. okay? And you can see that U.S. oil consumption has, in fact, by and large, really corresponded very much to what we predicted many years ago. In fact, the Europeans are dead on that red dotted line. They're actually right on it. Now, the question becomes how the U.S. is going to respond right now. We've started increasing our oil demand very quickly in the last quarter. And then the question is this arising because China is not competing for this? So we have softer prices, the economy gets used to the oil price, everybody adjusts, and then you go, okay, then we can grow faster because now we've digested that need to increase our efficiency. Or, conversely, is this the result of the U.S. increasing oil production? How much of our incremental oil production do we get to consume? Is it nothing? Because up until the middle of last year, we had increased our oil production by 3 million barrels a day, and the U.S. had not consumed a single barrel of it. Virtually all of that went to the emerging economies. Okay? So now we have 5 million barrels. The question is, does the U.S. get to consume any of those barrels, or do we export them all effectively as we did before? We cut our net imports, to be more clear. Okay? So, and the answer is I don't know that, but I can tell you that for the U.S., if we're talking about U.S. consumption, one of the things we now have to calculate with is, does increased U.S. production of oil affect U.S. consumption? That has a really important implications for example, our refinery sector. Do we need more refineries or fewer? Is refining going to be a positive business or a negative business? Well, if consumption is falling as it is in Europe, the refiners are all dying there, right? But for us, if our consumption can go up because we're producing more, then our downstream outlook is correspondingly better.